All right, we're back with Ben Bajarin. It was an absolute pleasure to have him on back in September 2023. It feels like the world has, it feels like many leap moon years have passed since we last chatted. Like the world, it's AI everything. We're fortunate to have him join us then, CEO of Creative Strategies, and also, might I add, principal analyst. The work is done in-house in that brain right there. Ben, how are you?
I'm doing good. Thanks for having me back.
Thank you very much, Scott. Andy, it's been a heck of a ride since Ben last joined us. So why don't I kick it off, right? So Ben, since we last spoke, September 2023, the whole AI ecosystem with Nvidia right in the center of it. To say that it's gone into a state of overdrive would almost feel like an understatement, right? It just feels like, we're in these almost parabolic moves of just consumption and the understanding of what AI can do. Maybe you could provide an overview of the current supply and demand landscape and Nvidia's competitive positioning within it, but just more broadly, a state of the union, if you will.
Yeah. It's interesting too, because, it feels like your observation that, we're moving in like dog years is definitely like apt, but at the same time, we're not actually very much farther in the AI cycle than we were like when, we first chatted. Like it feels like, oh, everybody should be using this on a regular basis. And the reality is they don't. Like we're still just training models, trying to move toward a more sophisticated level of intelligence, right? And that's the work that's going into. And so because of that, all that really does is still suggest we're in a heavy infrastructure as part of this cycle. And that's where, NVIDIA's role comes into play, is that they're still the dominant player. I think the most recent market share estimate was something like 92% of GPUs to AI is NVIDIA's market share, what they sell into that. And we're also at a point in time where the entire industry is sort of evolving in their data centers from just general purpose, right? Data centers, which when I say a general purpose server, that's like the stuff that runs your websites, right? The stuff that ran Amazon.com and Walmart.com, hosted services for email or whatever, right? So those are the kind of things where that the market's moving from kind of those just basic servers to these much more sophisticated AI servers. And that's just starting, right? I mean, I think the estimated shipments for AI servers this year was something like 13%. So it's not even the vast majority, right, of the market. So we're in this infrastructure stage. And as of right now, NVIDIA is really the dominant player for the AI server ecosystem. And that doesn't seem to be changing. Everybody wants their next generation part, Blackwell. Blackwell has as much, if not more demand than Hopper. So we see this continuing very strongly into next year for all the dynamics that I just laid out, is that people are spending more to re-equip their infrastructure to AI servers. AI servers will grow again, to a higher percentage, maybe close to 20%, I think is the estimate next year. So you can see how there's a long roadmap or a long runway here, also a very expensive one. And the ASP of an AI server is like 400% more than a general purpose server. So people spend more on these things. And NVIDIA right now feels like no one's going to threaten them in this space when it comes to the infrastructure build out. They're going to be at the center for the foreseeable future. And it doesn't seem like that's changing.
Now, Ben, I wanted to move a little bit onto the models. I'm trying to better understand. So we've seen the models seem to be improving quite significantly, but it's been, if you look over a few years, say from 2020, it's been a fast rate, but a predictable rate. It hasn't been an exponential growth. It hasn't been speeding up per se. So I'm just trying to help us understand what is the key to significant improvements in models going forward. I mean, does most of the improvements in these models come from just more data? And if my big question is, if we run out of, say they ingest all the data that's publicly available and they train on it, can they keep getting better if they've used it all up? What else can happen that can make the models get more accurate as time goes on? Is it just feed in more data problem, or are there other ways to push the ball down the road?
Yeah, so there's data, there's new elements of tuning that come in, right? People talk a lot about LoRa and RAG today. There's another one that they're that's starting to be implemented called Tree of Knowledge, which basically puts together a whole host of different domain-specific expertise of knowledge, and then it's able to sort of assemble those together logically. So there's still innovation in what let's just call the framework of the model. So it's not just one big model of data, one LLM. It might be a whole combination of these together. And there's a lot of still domain specific fine tuning that needs to happen, right? Even Nvidia is doing this, right? They're making BioNeMo, which is just specific for the bio industry and big pharma. You've got people training these things specifically on user behavior. You've got people building these right for legal, for taxes, and so there's all of this stuff. And eventually, that's going to come together. So if we believe that those fine-tuned domain-specific models continue to get really good and really smart, then once we can start assembling all of these together, it's not just random, information on the web that we may or may not be able to trust. That right, LLM is able to pull from ones that we believe and we have trust are domain specific, and that's going to help. That's going to help out a lot. And really, I think the best way to understand this is the way you see Apple, the way you see Google, and even Microsoft to a degree use their on-device models is with these small language models. And small language models are just very fine-tuned to be very good at a very certain amount of things, right? So just take what I said philosophically and expand that to larger models, that we have all of these big models that are fine-tuned, very good at a few things, and then let's combine them all together with either Tree of Knowledge or RAG or however that gets assembled, and you're going to see a lot of improvement. And that's sort of where we're kind of marching toward right now, and that there's still a lot of work to do. The other part being we want these to be more predictive and anticipatory in nature, so not just have data but be able to know what your query is, maybe much more semantic index. A lot of training is going to have to go into that. So there's a ton of evolution to still happen, but these kind of new paradigms for how models are trained and fine-tuned becomes still large but domain specific. A lot of that work is still very early days, but that's kind of what we're in the middle of right now.
Now, could I ask you on the data front, have you heard any good information or talked to anyone that has an opinion on how far we are down the road of training on all the data that's out there? I mean, are there still lots of walled gardens of data like Apple, for example, that hasn't really gone out there where those more specific models can get trained on that? Or have they really like sucked up a big proportion of the data that's out there that, that's besides what's in a library that may have to be scanned on the internet?
Yeah, I mean, there's two things, right? I think we're still being able to ingest more global public information, right? And so what also is not in there is really audio or video data, right? So we're still not getting media. It does very good with text, but there's a whole form of media out there that'll come into this, right? That's really hard, right? How would a server understand a video and then ingest that video and learn from it so that you've got query, context, et cetera, right? So there's more media that comes, but then there's also, what you're seeing all of the enterprises do, which is try to train models just on their data. And that's not going to be public data, right? That's going to be domain specific assets to their organization. And they're going to want to mix that with broader information or other sets of domain expertise so that their employees have all of these capabilities, a mix of their data and a mix of public data, right? Whatever that is, compliance data, government data, right? If it's taxes. So there's sort of the ingesting and training of all of that different data that might be proprietary, but still be able to leverage the broader, domain of the internet or context models. And so that's just why everybody's in training mode right now. And there's really no conclusion to how they want to use that, if they've even trained it the right way. So there's still a lot of trial and error happening, especially with enterprises we hear. And that's just why I say, like, we're still squarely in this training mode, and we haven't quite moved to the next phase where you're just inferencing those things. You've got, hundreds of millions, billions of people just querying data that's now accurate, domain specific, trust verifiable, safe. And we'll get there at some point, but we're just not there yet.
I have to assume that all this interaction that's happening between us and ChatGPT, for example, are they using that as well to train? Because that should be some learnings, right?
So yes, but at the same time, right? That's generative data that might not be accurate, right? So the output of that is data that didn't exist before. So there might be helpfulness in understanding your query, like what you're trying to get to. But because we know that information either isn't always accurate or it's already just information that exists displayed to you in a different way, right? In a more natural language way. What they're getting more information for is sort of your query, or if you, which is where the sensitivity is, right? You got enterprises for people who are just sending private PDFs to ChatGPT and then querying it, and they're like, you can't do that. Like you can't send our private information just because you want to get a summary of it. So that's why the organization needs its own LLM so that you can query your PDFs, right? Be able to have that discourse, but maybe do it in a way like if you're a healthcare industry, if you're taxes, if you're financial, like you want specific information to that. So they might need a more specific domain expertise model for that industry. But the output of that is not very helpful because again, it may not be accurate. It may be too light on content, not rich enough. And again, it's just displaying existing information to you. It's not necessarily creating something entirely brand new holistically. At some point it will though, but that's not yet today.
Ben, on the enterprise level, just because all of the everything we've heard is it's the hyperscalers. They that's the predominant capex spend right now. Maybe do we have a estimate on how enterprises, large mid-sized enterprises are entering this field, or are they still on the sidelines, or do we have any good visibility there?
Yeah, so what we know is most organizations of relevant size have projects going. They've basically someone internally has said we need to figure out how to use this. We need to look at every facet of our business, whether that's the finance side, the creative side, marketing, customer support, whatever. And that's the work that's happening right now. There are projects that are coming from existing IT budget, and I think that's relevant, right? Because we do track what does IT spending look like, and when might IT put a huge percentage of existing budget or new budget to the deployment of new software services, in this case AI. So right now, the budget that's coming from is just being taken from other things. So they're reprioritizing something that was down the list and saying, I'm going to take that budget and I'm going to put it toward this pilot project. And that's where we're at right now. And that's why when you hear companies say, well, we've deployed Microsoft Copilot and we're just still not sold, it is because they're just experimenting. They're just trying these out. They're not actually deploying at scale to everyone in their organization. And we don't know how long that's going to be. I think a lot of these organizations, right, they're seeing this for the first time. They're trying to figure out what the best efficiency is, what this means for productivity for the employees. They're trying to understand their costs. They're trying to understand if this is an on-prem model or if this is something they need to host in the cloud. So IT is just inundated with all of these different questions that they're still trying to answer. At some point, and I don't know when, but at some point they'll say, all right, we've got it. We know how to train this model. We know where we're going to host it. We know which parts of our organization we're going to deploy to first. It's just definitely not going to be 100%. They'll pick a few places where they get the most productivity and efficiency, and then they'll start to roll these out in scale. When that starts happening, it's going to start churning up more compute. The dollars will come on the software side, and we'll see this economic level from software monetizing the infrastructure that we have when that happens. But we don't know when, and we don't have visibility into when these things move from project to full deployment across a wide range of industries.
So we're still in the tinkering and training phase. We haven't seen a lot of I'm going to, ramp this up really, and this is going to be a foundational part of how my company works.
Correct. Yeah, and like I said, you're seeing good signs. Amazon had put out a statement saying something like, with the Copilot, they use a different term than coding copilots, but you know what I mean. With the coding assistants, they've shipped something north of like 60% of the code that was generated. So clearly that's good, right? But you got to have somebody editing that, making sure it's quality. But those coding assistants are doing a good job for them. You've seen Walmart sort of come out and say, look, this used to take us a bunch of time to ingest this data, train this data. This is saving us many man hours and dollars. So you're seeing positive signs, but you just don't have, right, the whole of all of these enterprises saying, okay, we're going to start deploying to our users, because again, right, that's when you can say, what's the cost per a customer? It may not be $30, right? It might not be what Microsoft's trying to get. It might be $10 or $15 per employee per cost. But again, put that up, right? Across the entire, in the United States, 100 and whatever, 40, 50 million knowledge workers, right, that are out there times X number, like there's a lot of dollars once they start deploying at scale.
Got it. Now, as NVIDIA investors, it's critical for us to kind of try to figure out where the CapEx cycle may go. If it's going to be more durable than people expect, well, then there's upside in NVIDIA and vice versa. Just wondering, based on everything you're seeing, do you think the risk is that there's going to be an air pocket in CapEx? Say everyone's testing and they just say, we just need to test a little bit longer. So then they don't ramp anything up, or they wait, they have a year of waiting and seeing, and then you see this CapEx fall? Or is the risk skewed, you think, to the CapEx cycle being more durable, where more than just the hyperscalers say, I need to spend more and really integrate AI?
Yeah, I mean, the reason I think this CapEx number is so high, and that's consolidated to the hyperscalers, is just simply because they're turning over infrastructure, right? They're shifting racks that were general purpose to AI. AI adds an entirely new challenge of cooling. These racks typically in a general purpose server have consumed less than 700 watts of energy per rack. Now we're topping 1100. So they have to go and cool these things in new ways, because air can't cool something north of 700. That's why you hear about direct to chip and liquid cooling. That's not cheap. So you've got all of these added costs. Energy costs are exponentially higher to do this. And then in some cases, you can only deploy less AI servers per square foot than general purpose, because the racks are, like you saw that in video on the GGX system. It's gigantic. Like the three of us could maybe lift that thing, right? Compared to a thin blade, right? A one tiny thin cubic blade where you could put 15, right? So you just can't do it. So you need more foot space. They're increasing square foot. In fact, I heard somewhere that the first 1,000,000 square foot data center is currently in construction. And like, that's insane. Like 5 years ago, we'd have been like, let's make these things smaller, not bigger. And now they're like, we need more space. So that's why it's expensive. And that's consolidated to the hyperscalers, right? You don't see enterprises yet saying, I need to convert more space to on-prem data centers. Now they may, that's a conversation that I think is being had, but the needs of an enterprise for their on-prem workloads is far different, right, than a data center. They may not need nearly as many racks, nearly as much foot space, but there will be a cost to that. But it's not the same as the hyperscalers, who are also turning over equipment now on a 2-year basis versus a 3 to 4 year basis like it was before. So, and that's just because the performance gains you're getting in new products from Nvidia is so high, it's worth it to you to spend more money on the next product generation. So the CapEx is consolidated. There will be more spend in CapEx with enterprises once they decide how much they're going to put on prem, but we're not there yet. So the CapEx is led by the hyperscalers for now. And then there will be some parts of enterprise on-prem where this happens, but no one has a good idea of what, because again, they don't know how much of these workloads they want to run on-prem versus in the cloud.
So I'm wondering, is it inevitable that if you add up all the hyperscaler CapEx, that it has peaked in like the next 2 years, because you will have turned over so much of those racks just from how much they're spending? Or do we not really have a feel for whether, well, they might decide to turn over even more, and then CapEx is higher 3 years from now than people think when they're expecting a fall?
Yeah, I think the way I would look at it is, as soon as whatever the next products that come out from Nvidia, from AMD, right, from Intel, etc., as soon as those products start having very minimal year-over-year performance gains, and I'll just say like 20% or lower, meaning that the next product is only 20% better, it's going to slow down then. Because now you know that what you have is generally good enough, and you just don't need to turn your whole data center over for 20%, right, performance gains. But you're seeing 50% performance gains right now in product gen over gen, including drastic TCO value, right? So the time to train a big model on NVIDIA's new products has gone down to like 4 days, from 60 to 90. So like, that's a big deal. But at some point, Scott, you're right, that will slow down. And when that slows down, we will see that CapEx spend because they won't need to turn this over as quick.
But the performance indicator today is not saying that it wouldn't be worth it to upgrade at this point.
Sorry, say again?
I'm just saying, because you gave that number 20% or less, we're still seeing performance gains generation to generation, make it worth it to upgrade.
Absolutely. I mean, like I said, if it's 50%, even 40%, right? You move your time to train a model at your cost plus better energy savings down to where we're at and keep getting quicker. And the thing that I think is interesting is like, to your point about training, we train these things with sometimes outdated data because of how long that it takes. Imagine when we have the compute that information can be trained in real time, like literally real time, that the data, the things that happen right now in the world, news, information, stock analysis, etc., that LLM is trained and adapts in real time to what it's learning. That takes so much more compute than we have, and that's going to be a fascinating reality when it's not a static training environment but a dynamic one. And when that happens, I mean, honestly, like the implications of that are pretty significant to our interaction with data, and then perhaps an AI that becomes more, sentient and intelligent and anticipatory when this data is actually trained at scale in real time, in milliseconds, not in days. And that's the cost that we're going down. Again, not everybody's going to need to do that. There might be a handful of people in the world who need to do that. But my point is that generates a tremendous amount of compute. So there's still performance gains to be had. It's really expensive. It's becoming very hard. So it's not like we're looking at, this getting any easier. It's actually just going to get harder and more expensive, which again argues for Nvidia to be in such a good spot because of the technical advantage that they have. But there's still room to grow. And like I said, once that slows down, and it's like I said, I think 20% is a good number, right? 20% or less is a good number. It's just not worth it to put 80% of your data center over to a new product. You're good enough with your N-1 SKUs to still do what you want to do, and you're seeing value in those assets.
So just with respect to the competitive landscape, just on that point itself, maybe you can just kind of provide an overview of just, how strong NVIDIA's moat is right now, and, how you see that evolving, and, whether it's, AMD, like who is anyone even close to getting into the stadium? And I know, the conventional view is that it's not, I'd love to hear your take on, are the others just so far behind that we're talking about a 5-year catch up, or are there are there ladders in this game that they can pop up and catch up in certain aspects? Like I just would love to hear your take on that.
Yeah, so they have a, let's just say they have a technological moat in that GPUs are just really great for training. Like they are really, it's the right architecture to train gigantic amounts of data because of its parallelism. It may not be the best for inference. I think this is still a huge debate, which is why we have this conversation about what happens when the market moves to inferencing. Jensen likes to use this number that 40% of their dollars is inference. So he tries to say, yeah, we're still good for inference, or we're good for inference at scale, which is concurrent users inferencing at one time. And I do believe there's some logic to that. But the point is, like right now, from a training cycle, they're the best TCO. And I've not seen any analysis that comes up better than that. You can do this on Amazon's Trainium and Inferentia. You can run this analysis on AMD. You can run this analysis on Google's TPUs. They all take longer, cost more money, and consume more energy. So over the course of that time. So the TCO for NVIDIA is just still hands down the best. Part of their other lock-in, so it's not just that there's value right in the technology. You keep coming back to CUDA, and why is CUDA what it is? CUDA is what it is because it has this giant ecosystem, and if you want to write AI software, it really is just the easiest, and that's just where it is today. And until something else comes along, or a new paradigm shift for how we program and code these things, because it's not just PyTorch. When people come and say, oh, well, we support PyTorch, well, so does CUDA, plus a whole lot of other things that your software doesn't support. So they have this software developer moat as well, and a software moat as well. That's still, you just don't see any signs of this being overcome. Now again, in 6 months, in 10 months, who knows? Maybe this has changed. Maybe AMD catches up with some sort of a breakthrough, and their TCO gets better, then whatever the new version from Google's TPU might be, maybe it gets better, right? Because everybody's marching along. But with where we're at right now, the moat is still big, and there's still a gigantic technical advantage to and a TCO advantage to NVIDIA's products, and that seems relatively just unthreatened.
Now, could I expand on that with ASICs? Because I've heard some really good podcasts from people at startups saying they're going to come out with an ASIC that'll replace NVIDIA. And I go back to the early days of Bitcoin mining. You were using NVIDIA GPUs, and then it went totally to Antminers, to ASICs. How do you see ASICs fitting into the AI ecosystem? And could, for certain specific workloads, could ASICs take over in the shorter term? Or is this more like a multi-year thing?
Yeah, I mean that's the thing, right? So everything I sort of laid out, right? The Google's TPU, Microsoft's Maya, Amazon's Trainium, these are all ASICs. These are all custom ASICs designed to do some form of that workload. As of now, they're good. They're not bad, right? I think Apple's research paper came out, said they trained all of Apple Intelligence on Google's TPUs, so doable, right, for a company of their size. Not bad. Like I said, it does take more time, more energy, and more money, but it is doable, right, if you like it. And that I do think is the potential biggest threat, because all the hyperscalers are building these because they do want those workloads. They don't want to be behoved to Nvidia, and they want to keep their costs and their energy costs down. So they're actually trying to build these things far more energy efficient. Even if they're less compute intense, they're more energy efficient, which is again why they take so long than Nvidia's processors. So that's the biggest threat. It's just that right now they're not even close. And maybe they will be, right? Maybe they will be in 2 years. Maybe they will be in 3 years. I don't know. But the bottom line is right now, they're really not. And this is why there's just still a giant line to buy NVIDIA products, and people sitting there waiting for any instance they can get, while TPU instances, Amazon's instances, like the competing instances are there, but people are still going for NVIDIA's.
Man, this feels like the best future test of, I don't know if you're familiar with Clayton Christensen's Innovator's Dilemma. So this is a coming innovator's dilemma potentially for NVIDIA, right? Because if ASICs end up getting better, I think right now maybe we don't know exactly what ASIC is needed for the specific task. So say an ASIC comes that's better and it's naturally cheaper because it's more specific and more cost effective, everything. Does NVIDIA move into that market to protect market share, hurt its pricing power, or does it go up market? That's the innovator's dilemma. So I'm very curious to see how this plays out.
Yeah, and I think that's why, if you paid attention to, their earnings call, there was a lot of questions from analysts around, why not monetize software? Why not start charging for more of your software stack? And it's because they may wrongly only view NVIDIA as a hardware player, but again, a lot of their money is from hardware revenue, right? They sell production hardware systems, and that's how they make money. And they wanted to see something that was more, well, when that starts to slow down and you can't just sell the same amount of hardware every year, how else are you going to make money? And that's why these software questions come out. And I really don't think that's off the table. I think right now they just care that they get an entrenched and locked in group of people training and using NVIDIA software, and then they can throw some, maybe it's another $15 a month, right, per user or whatever, right? So I don't think that's off the table, but that's not where they're at right now in the cycle. But you're right. There's a lot of different ways they could go. They're investing very heavily in the CPU side. I think this is interesting because, all from the Intel, AMD, ARM, et cetera, like they all will come out and admit that a very good host CPU unlocks a lot of the potential for a good GPU. In fact, so a GPU is actually not as efficient if it's got a very bad host processor or slow host processor associated with it. So that's why NVIDIA is making their own ARM CPU that was in a first generation. I expect that to get drastically better because those two things actually make that product even better, right? So they've got more and more of the stack that they can keep offering to get that lock-in, to get that TCO, to bring those efficiencies. And that's really their focused roadmap right now. But they'll have options, right? Once this starts to slow down, they'll have other business model options available to them, if they so choose. That's just not what they're doing right now because they don't need to.
So Ben, one of the biggest pushbacks for, against this AI revolution is the industry has yet to see, I'm talking downstream, user wise, material returns on invested capital. Do you share the view that hyperscalers are all in and will continue to drive CapEx, even if they aren't seeing near-term returns? Because the AI market is just so big and so significant, and that this is effectively really about an existential survival, right? I would love to get your take on. Are we just going to continue? Are they going to just spend through this?
Yeah, I mean, I think if you look at this historically, and this to me is just the right framework. We can nitpick at what does that look like at the end of the day in terms of execution, but we're very much in you hear this all the time, right? Picks and shovels. But I think the better way to look at it is we're in digging of canals in cities. We're in laying of roads. We're in laying of fiber or the railroads. Somebody's laying infrastructure so that they can own a giant chunk of it as much as they can, so that if you want commerce to happen, if you want industry to happen, you have to go through us. And that's what these three hyperscalers are doing. That's what Microsoft, Amazon, and Google is doing. They believe that that's where we're at, so that everything related to using AI, monetizing AI, the business has to go through their railroads, their infrastructure. And that's the race. It's just a race. It's a race to grab up as much quality infrastructure as you can so that you can own a critical piece of that economic flow, right, in monetizing AI. And there's just no way that's going to stop because, again, right, if you've looked at the history of all the industries that I just said, those who spent the most money and owned the most canals or owned the most fiber or railroads or roads, those were the ones that ended up benefiting, right, from the economic boom that enabled. So they know this. This is why they're just absolutely going to keep spending to make sure that somebody doesn't get more of that infrastructure than them, that they can compete. And, and like I said, this is an increasingly expensive endeavor. So we don't have big, law of large numbers economics favoring us right now because this is hard technology problems to solve. So it's getting more expensive. So they're going to have to keep spending more. So I don't see that slowing down, at least for the next year. Everything I'm saying, let's just look at this in year timeframes. That's about as far as I think we can see. I don't see it slowing down for that year. Reassess again in a year, and we'll see where we're at. But right now, it's a land grab. It's a mine for as much gold. Build that infrastructure. Get into a position so that all the dollars have to flow through us. Because the people are right, and this is AI, monetizing AI is a $3-4 trillion market. They want 30% of that, 60% of that, 70% of that. This is the fight for those dollars, huge dollar numbers we're talking about. So they're going to fight this to the death because they are the only ones that can. They're the only ones with the infrastructure. And so that's the future that they see. So at least not slowing down for a good another year.
Ben, could you help me understand what Meta's strategy is with, making Llama open source? Are they using that as a competitive angle for these other guys like Google, or is it more for their internal to speed up their processes and their end product, what the user interacts with?
Yeah, it's a little bit of both. I mean, obviously, they need to see a commercial benefit to this for their ecosystem, right? They whether that's stickiness, whether that drives ARPU, right? Because that's really Meta's number. It's just driving higher revenue per user, right? Whatever that looks like. I think they also want to some degree, play kind of disruptor for these other people by saying, look, we train a model, we make it cheaper for you to use these tools. And then there's compatibility, right? As more of these models go out into the world, it makes it a little bit easier for others to build on your infrastructure. And then maybe, you charge for that at some point today, right? Think about it in terms of OpenAI, right? OpenAI's and Anthropic's, Perplexity's, Google, Microsoft, you name it. They want people to pay to build on top of that infrastructure in terms of just tokens, or whatever. So there's a part of that where a monetization angle can become clear if you get critical mass, right? You need that critical mass. And that's the question, is that we just don't know what the dominant platform is. We don't know who shakes out if this gets bigger or gets smaller in terms of number of players. But Facebook wants to be there, and I can't imagine that they don't want to try to monetize this with some level of compatibility. If they have the best model, eventually, people might use it and then pay them a small license or royalty or something. So there has to be a longer game here than just generosity, right? Let's just do it and give it to everybody. Open source is great, but like I said, they've got internal reasons, and I think they've got some strategic external reasons that they hope play in their favor.
Got it. So the last one for me, I just wanted to hit on is the delays to the new Blackwell GPUs. So it looks like it's only been about 3 months or so. So I mean, the market didn't take it that hard, but I'm just wondering, how common is this type of setback in semi manufacturing, and what do you think the chances are that this could potentially snowball, where they said 3 months and now they say, oh well, we're running into some more problems, now it's going to be middle of the year? Like, your take from your experience.
Yeah, I mean, yeah, the sad example I have to give, because I'm actually not hard on this company, I am very optimistic, right, is Intel. And typically delays to Intel's product line have just had drastic implications throughout the ecosystem and or their product ecosystem. What happened was Nvidia was using a much more advanced process of CoWoS from TSMC, and it was an immature process. And to be honest with you, that's just always the risk, right? When you jump to the most cutting edge, there's yield issues. It's an unrefined process, and Nvidia is playing the role of, to some degree, pipe cleaner for this advanced process at CoWoS to help it mature. Right? They're paying for that. They'll actually get some discounts by being the first customer. You always give discounts to your first customer that serves as pipe cleaner. But that's sort of what they were running into. They then made a slight change, which allowed them to not have to be so dependent on that leading edge immature process. And we'll get there eventually, but where it is right now, and that change minimized those delays. So there's always going to be that risk. This is also, to be honest with you, a mix between TSMC's, just where they're at in that process technologically, the scale that Nvidia needs to do this, because they do need a fair amount of wafers for advanced packaging. So there's always risks in doing that, but at the same time, they felt they needed to do that, right? They needed to bond these two chips together, these two GPUs together, in a way to increase this performance. Like, that's how they wanted to get it, right? So you could imagine, because I've speculated this for Apple too, right? Apple did a very similar thing with the M Ultra series, where they just took two chips and bonded them together in advanced packaging. Well, why not do 4? What if we could stitch 4 chips together, right? Sure, it consumes more energy, but we can package these things in very different ways. So we'll move from 2, let's stitch 4, maybe we stitch 8, like, who knows, right? There's ways this can go, but that requires these advanced process techniques that are brand new. We've never really done this before. We've never taken 2 monolithic dies and sort of stitched them together. Like, this is new territory in the last couple of years. So it's expensive and hard and kind of groundbreaking. And because of that, they pushed the envelope, and luckily they adapted. I'm sure they learned from that, but this isn't going to be the last time that anybody, name your semiconductor company, comes up against extremely challenging views of physics and quantum physics, which is essentially what semiconductors is. Like, more of this will happen. It will really come down to their ability to manage it, help solve those problems, engineering problems, and then minimize these delays as they try to keep breaking new ground at cutting edge ways, in order to not have any delay. But again, it was needed to get the efficiency that's going to make Blackwell so demanding of a product. So I don't fault them for that, and I don't think the market truly faulted them for that. I think there's other things going on around just the cycle that we're in that kind of penalize that a bit more. But it sounds like Nvidia managed that well. They solved the problem, and these delays are going to be relatively minimal, and more importantly, they're going to have a lot more demand for Blackwell even than Hopper, with a product that costs more. So,
Ben, always so much insight. A big thank you. Now, before we go, for those listening, you got to follow Ben on Twitter. That's how we found Ben. This was when there were like crazies in the zoo. I mean, they're still on. It's still on. We I think our last conversation
X is a little more subdued than it was during COVID, though. I'll say that.
Yes,
I think that's
true. It's true.
That's what spurred our last conversation to get together. It was like the Zoom was like bananas, but follow Ben. He's a good zookeeper. Keep keeping it all together. But fantastic follow on Twitter. But more than that, creative strategies. Could you give us our listeners what you do there? And in addition to that, you got a fantastic pod, The Circuit. Tell us about both.
Yeah, so our company, Creative Strategies, very in the camp of industry analysts. So our legacy was very similar to Gartner, IDC. We don't do a lot of forecasts and models, tracking of sales of data of things anymore. There's enough people that do that. We spend a lot of our time with companies we work with, just digging into helping them compete, helping them look at strategy, evaluate the market, evaluate technology. And our focus is just really, really skewed toward competitive advantage and differentiation. Like when I analyze a company, whether we work with them or not, like all I care is, can you be easily disrupted by somebody else? Like how sustainable are the things you're working on? And because we're in the technology industry, that's often a very technical conversation. It's not just we sell things cheaper, right? That's just not always the right answer. So we put a lot of competitive advantage, competitive differentiation, and that skews our analysis. And that's just the lens that I bias toward with everything that I look at. My background was in semis. It doesn't just do semis. Like people will see me on CNBC next week talking about Apple because we spend a lot of time on consumer hardware. We spend a lot of time on enterprise software. So our firm covers sort of the gamut. We've got people with domain expertise everywhere. But since semis is hot, again, it's kind of the thing to talk to. So I get pulled into a lot of those conversations, hence my podcast, The Circuit, which is very focused on the business of semiconductors. And we frequently have high-level executives from the semiconductor industry as guests, and we talk about that every week. So that's my dedicated podcast to semi. So check that out.
Fantastic.
Yeah, it's great.
Thank you very much, Ben. Can't wait to do it again. That's Ben Bajarin, Creative Strategies, The Circuit, and keeping Twitter in check.
We do what we can. Yeah, anytime. Happy to have on. Thanks for having me on again, guys.